Are you looking to learn more about investing in the central Indiana real estate market? You've come to the right place. Welcome to the Indy Real Estate Investing Podcast with T&H Realty, where we discuss all things related to investing in the central Indiana real estate market. Thank you for listening and enjoy the show.
Hello, everyone, and welcome to another episode of the Indy Real Estate Investing Podcast. I'm your host, Jeremy Tallman with T&H Realty. We are a residential property management company that services the central Indiana market. With me once again today is my business partner, co-founder, and president of T&H Realty Services, Scott Hallberg. Welcome back, Scott.
Yeah, thank you. It's good to be back. It's been a little while. It's been a busy first half of the year, and you guys have been killing it on the podcast.
Well, thanks for that. Yeah, it is busy. I mean, I think every property management company in central Indiana is feeling the crush of that summer rush that we always get. But today I want to bring you on to talk about the top 4 mistakes new investors make. And I think this is a relevant topic you and I have been talking about. I talk about it a lot with Jake, our business development manager, because the bottom line, the appetite for investment properties in central Indiana is still very high. So we have the normal, we'll call them experienced out-of-state investors coming to our market and still want to buy and buy in volume. But what we're seeing now, there's probably a lot of reasons for it. We're seeing a lot of people who are now converting their personal residence into their rental home. And that could be intentionally. It could be that they have such a great interest rate on their property that they don't want to give up that cheap money. And so there's like, well, I'll just rent it. And there could be people occasionally, we're not seeing a lot of this yet, but it does happen, is that we're seeing people who say, I really can't sell my home, so I'm going to rent it. So regardless of, the reasons or whatever, the biggest point here is that we're getting a lot of newbie investors calling us. And in most cases, they're really interested in being landlords. So I thought it made sense to bring you on, Scott, to talk about some of the common mistakes we see with new investors. You talk to a ton of clients. I hear you're across the hall from each other. I hear you're on your phone a lot with clients. You correspond with a lot of clients. You have a really good pulse, as good as anyone probably in central Indiana, of what new investors are facing, what they're fearing, and let's face it, some mistakes they make. So let's get into the list for a minute. You and I worked on this a bit. It wasn't, I don't think, that hard for us to come up with it because we see some patterns and we want to talk a little bit about that. So the first mistake is that new investors don't treat their rental business or their rental property rather as a small business. And we came up with kind of 4 components, and I'll let you start here. The first one of they don't really prepare in terms of creating an escrow reserve or a bank of money. So talk about that a little bit and what you see there.
Yeah. Overall, I mean, it is a small business now. And I think that's the biggest mind shift you have to make, be it coming from your personal home and you had that personal attachment. Hey, that's my pride and joy. And, you have to leave it for some reason. You can't sell it, or you're just going to be gone for a temporary bit and you want to rent it while you're absent. But yeah, I mean, obviously it becomes a business at that point, and, love it or hate it, you have to have that mindset. And there's certain components to set up a good business in general, not just for rental businesses, but for, life in general and operating a business, is to set up an escrow reserve. And that is basically to have a rainy day fund or a just in case fund. We recommend at a minimum 3 months of operating expenses in reserve. So that way, if you have a surprise maintenance issue, a crisis that happens, a surprise vacancy, you have funds that you can use to bridge that gap or take care of that issue.
Right. Yeah, I think I heard someone call it a SWAN account, which is a sweep all at night account. You can call it whatever you want. Like you mentioned, you had several there too, but it's just, you're right. You've got to have some sort of reserve. And I don't know what you think, Scott. I've been thinking about this a minute. It almost feels like 3 months in today's environment isn't enough, because I think we've seen the cost of material and labor outpace rents. I mean, rents have went crazy, but labor and material have went up even more. So do you have any thoughts go off script here a minute, but do you have any thoughts about, should that be 6 months, 4 months? Because if you have let's say you have a $1,200 rental, you got $3,600 in reserve. We know HVAC systems cost more than $3,600 today. That's just the reality. So I don't know if you have any thoughts on that or not.
Yeah, I mean, there's no doubt that more is better.
Mhm. Yeah.
But as far as like, you got to balance that cash flow versus, setting up and paying your bills. I mean, yeah, we have our
Right.
own portfolio we've been managing and owning for over 20 years. And we have a series of reserves that we set up. I mean, some for taxes, some for insurance, some for repairs and maintenance.
Yeah.
And so, yeah, you got to factor all that together and, be it one rental where your scenario that you have, $12,000 of income coming in and your reserves 3,600. Yeah, I mean, that's not going to go very far in today's market, unfortunately.
Yeah.
Where an AC or a furnace can very easily exceed that. So yeah, it depends. I mean, I think I've read things where you want to set up at least a 10% maintenance reserve per month, and that can build over time. So that's on top of it, maybe your 3 month. So start with 3 months, as a
Right.
seed,
Right.
and then build from there is, I
Yeah.
guess, what I'd recommend.
Yeah, that's good stuff. I mean, so it goes back to like, don't use January's rent to pay January's mortgage. You have to have reserves set up, because if you don't, you're going to just set yourself up for failure. Okay. Let's move on to the second piece of this mistake, number one, and that is treating residents as customers. Your thoughts on that?
Yeah, I think it goes back to a variety of different topics here that relate to that. I mean, real estate investing and then becoming a landlord is a client and customer service industry. So you're providing your product, which is the home, is going to attract a group of people to live in it, and those become your customers. So,
Right.
There's definitely a divide. I mean, there's the whole stereotype of landlord versus resident, and some states have a variety of different rules to help favor either one of those parties. Fortunately, in Indiana, we're a little more landlord friendly, I suppose.
Yeah.
But there are tenants' rights, and we definitely abide by those, and we definitely recommend that. But the biggest thing is that these are people, and you want to treat them well to retain them, and you hope that they take good care of your property, pay your rent on time, and providing a little customer service at times goes a long way. So you build that rapport with them, and I hope we do that as a company for our owners. But if you have that natural wedge where, hey, they're just a tenant or they're just a resident, and you treat them as some, I'm not saying that very many people do this, but if you have this like subpar mentality about them where they're somehow below you or whatever, then yeah, it can cause problems. And we definitely want to try to minimize vacancy and maximize rent potential, and keeping people happy and providing a good place to live is really the mentality that we hope that all our landlords have.
Yeah. Yeah. It's important. I mean, I think you're right. I think landlords and that's not, blanket statements. Some landlords automatically assume an adversarial relationship that the tenant's going to, call in every little maintenance issue possible, pay rent at the last minute, just be difficult. But it is so important to create that in good environment, because like you mentioned, retention, if tenants feel like they're being treated well, they're more likely to stay, and vacancy is not a good thing for landlords. So you want to try to create that environment where everyone's happy, because that's just a much better place to operate from. So, okay. The third component of not treating a rental business or your rental property as a small business is failure to build the right team. So talk about that for a minute.
Yeah. I mean, the team is very important, especially if you're out of state investor. When you're X miles away, be it a few hundred or a few thousand, it's hard to just be there, have your boots on the ground. And so you have to have someone you can trust deal with the physical aspects of property management. We have a great blog that we did several years ago that talks about building the dream team.
Mm-hmm.
I think back of our 2 decades of being landlords, when we first started, we did it all when we were local, and we actually lived very close to many of our properties at the time in Broad Ripple. But, we got up in the middle of the night, had to go let people in the house. We had to paint houses on weekends and that type of thing. I mean, we were able to do that hands-on, but we were younger,
right?
A little more time. And you've done some things recently talking about, there's that line where your time becomes more valuable than the cost of service. So,
Right.
At some point you need to hire people to do, and I know I sleep better at night, not just in real estate, but like, for example, financial services. I have a broker that handles my financial services. I just feel like it's something I can't dedicate my life to knowing everything about. I hired someone that can do that for me. And, so therefore, we have a blog that says you should have, maybe a property manager, a lawyer, a CPA. There's people that you should have, and building a good team is going to help you sleep at night. It's going to help make sure the right things happen, and that your investment is on the right path as much as anyone can control. So, a property management firm or a single property manager in your stead is the biggest piece of that. To me, it's going to be the day-to-day need that you're probably going to have.
Right. Yeah.
If you're not going to do it yourself.
Right. Yeah. And even if you're going to do it yourself, I mean, a CPA is so important because, QuickBooks has or not QuickBooks, but TurboTax, or they have like a rental add-on or something. But, look, this is important stuff. And as you're building your wealth, you don't want to expose yourself to audits and problems. So again, even if you're a do-it-yourself landlord, CPAs are important. Lawyers are important because you're going to have questions. We still have questions, right? I mean, there's still times like, gosh, that's a strange scenario. So we consult our attorney and we know her number and she's easy to reach. And it's just so valuable to have that expertise in your corner. So, all right. And the fourth component of not treating your property as a rental, a small business rather, is not establishing goals. Talk about that for a minute.
Right. I think goals are important. I mean, if you don't have, those set, then your company or just your overall success can wander. And, so I think it comes down to, understanding the financial aspects of the business, having the metrics that you can measure to determine if you're on target or not. And then at the end of the year, or, monthly or whatever frequency you do a check-in on, you can kind of see if you're hitting those goals or not. There's obviously different strategies in real estate investing. Some people have short-term goals. Some people have long-term goals. There's no right or wrong. It really comes down to what your personal ambition is. But, for example, most of our properties have been long-term holds. And I think that the long-term game is a very noble game. And it's something that ultimately, we believe in. But, there's other strategies out there. We've done other things in the past. We've done short-term, we've flipped homes, we've done things like that. So, there's a variety of different options. And if you don't establish a set plan for the particular property that, you're looking at, you won't know what you're shooting for.
Right. Yeah. I think that's right. It's exactly right. And because I think it's important, like you're right. You and I, we've said, look, we want to hold these properties like a long time. And we're still talking about that. Like, how long do we want to hold these things? Right. Because we're in the 50s and it's like, how much longer do we want to be landlords? And right now it's like, we don't have any desire to sell. There's been plenty of opportunities to sell. But it's like, we just always felt like that's a long-term, part of our business there is our rental properties. But it is important to understand what you want to do, have some end games. So like if, I want to rent this long-term, or I could flip it, or whatever it is, just come up with a plan for the property. Like you mentioned, you can measure and when you set those goals, you can measure your results against what your expectations were. So, all right, that was a lot. That's because we do firmly believe that a lot of landlords, new landlords particularly, don't treat their rental property as a small business. And we're firm believers that you need to do that. So we spent a little extra time on that mistake. Moving on to mistake number 2 that new investors make, and that is underestimating everything. Your thoughts on that, Scott?
Yeah, I was thinking about that, and it goes back to, look, when we first started, we made our mistakes. I mean, we didn't have a smooth path every single day. As you hit it, we're in our 50s now. We've lived, a while, and as you get older, you become wiser.
Right.
That's the only benefit to getting older, I
Should.
guess.
Right.
But overall, one of the things that I was trying to think back of what we used to do, what things happened to us early in our property investing career, is that we underestimate everything. I mean, I don't know if it was over exuberance and we were overly optimistic, thought we could control it all. Those are the things that I think about, and over time we started building in a little more worst case scenario modeling and adding some contingency planning. But yeah, when it comes down to it, as far as like topics, cost and maintenance, especially the upstart side of it, making it rent ready is sometimes they need a lot, sometimes they don't. But just making sure you set the proper budget to either capitalize and build that asset and book that asset value with its startup included. And then after that goes live and becomes a rental property, then just setting the proper expectations on how much maintenance you're going to have, and not hoping that everything's going to be perfect. Even a completely rehabbed home or a new home, things will break and there will be maintenance. And then when there's vacancy, I mean, depending on the time of year, sometimes filling a home, especially in central Indiana, can be a challenge. I mean, you have seasonal effect a little bit here where in a winter, it does slow down a little bit, but overall, just setting up a proper expectation for those periods. And, I go back to maybe our bankers helped us with that. They used to, we used to go to them for loans and they would factor back out a lot of things. And that kind of showed us that, they were taking, not worst case scenario into consideration, but not best case either. So somewhere in the middle. Yeah. And that helped us kind of build a better expectation later in like midstream of our career, where by the time we had done it a few years, I think we had a little less stress and we kind of rolled with the bumps a little better at that point.
Yeah, some good points. And we both seen pro formas from, let's call them, I don't know what we call them, real estate educators, real estate, whatever you want to call them.
Consultative services.
Yeah. And they're just like so far off from reality. I mean, like 5% maintenance, 5% vacancy. You're going to, and to make that even worse is that like we mentioned before, the cost of things have just went up. So we even have, investors that have been with us for a long time that paid X amount for a furnace, let's say in 2018, and now they have to get a new furnace, or maybe it's a different house and they're paying a lot more. And so it is, I think we see that just in our own stuff. It's like, wow, this stuff is getting really expensive. So it's important to be conservative in your modeling. And like you mentioned, vacancy, we've had great experiences. You and I have had tenants for 20 plus years.
Yeah.
Right. I mean, it's amazing. Now that is not normal. So listener, don't think that's normal. It's not. But because we've also had a lot of properties where it's one and out almost, it feels like every year. So you have to make the correct budgeting. You have to be conservative. Because if you don't, you're going to be disappointed and get frustrated. And unfortunately, we see some people that, set bad expectations, they underestimate everything. And within a 6 months or a year, they're out. They're like, this is not what I thought it was. And I want to get out. So that's problematic. Okay. Mistake number 3 that new investors make is overanalyzing every deal. So your thoughts on that one?
Yeah. I think, again, I go back to, early in the phase. I mean, I'm sure we analyzed things quite a bit, and, that's important. I mean, you got to do your due diligence, make sure you run some numbers, kick the tires, look at things from a couple different angles, and, developing a checklist and maybe a proven process for that would help. I mean, I know over time we built some modeling that helped us.
Right.
I mean, eventually we went into the arena where we were buying homes with very little time, be it the auctions and things like that. So we had to hone our skills and practices on very quick decisions.
Yeah.
Also I'm a big believer in some of the, theories out there like the blink theory and just things that you make decisions off your gut a little bit. But I wouldn't recommend investing in real estate that way necessarily, but it's like, you definitely don't want to over analyze and have paralysis. I don't see that on this side, the areas that I manage. I know this is more on the brokerage side probably, but I do see a little bit on like maintenance costs where someone will want to get, 3 to 5 bids for a paint job. And you're thinking, okay, I get it. I mean, everyone wants to get a good value and they want to, save money if they can. I mean, in your personal life and in business life, it's always important. But at the same time, when you really stop and think about what that does, is it really slows the process down. And, to get 5 different contractors out there to give you numbers, I mean, that could take some time. And then you're going to piss off 4 of them probably, the fact that you're not going to give the deal to them. And then what you've done is you've burned all that daylight where you've just had the extra vacancy. So maybe you end up losing all your savings on vacancy, extra vacancy. So you may want to speak a little more on the brokerage side. That's more in your area.
Yeah, I think it's an interesting perspective, and I'm glad you brought it up because I think it's not only about deals, which again I see a lot of, and Devin, our broker, our lead broker, sees a lot more of than I would. But yeah, I think we are in a market of rising values, and you and I have talked about this because we struggle with it because we look at, okay, there's a 2-bedroom, 1-bath double in this area. Back in the day, we paid 90 for it, and now it's 270,000. That's a hard thing to get your brain around, right? Because it's like, well, we have one just like it, the same area, and we're going to have to pay 3 times as much for it. That is a hard mental barrier to get through. Now we're old. And so, but let's talk about the new person coming out there, because I remember the first deal we bought and it was hard. I have vivid memories of sitting in my car talking with you, and we'd seen it like 2 or 3 times. And I'm probably more aggressive that way. Maybe if I want to buy, I'm just that way. I'm a little less patient maybe than you are. And I'm like, you ready to do it? Ready to do it. And I remember like, okay, let's do it. And it was like, whoa, it felt like that's a big deal to buy your first property. We did look at several, but I don't think we wasted much time. We knew what we wanted to do and we went out and bought it. Here's my takeaway on this from the brokerage. And I've actually talked a lot about this. I wrote a blog about it. Is to me, if you have a long-term vision for property, it's hard to make a mistake buying a rental property. I mean, yeah, you could buy it and maybe a 2 or 3, it may take a while for it to appreciate because maybe you didn't buy it at a great deal. Maybe you overpaid for it even. But if you have a long-term perspective on it, it's almost impossible to lose money in real estate. And I'm not saying it's fail-safe. I'm not saying it's like guaranteed. But again, if you look at it over the long term, don't fret about paying an extra $1,000 or $2,000 or whatever it is. Because at the end of the day, that is nothing as a percentage of the gain that you should make, assuming we don't have some sort of apocalypse and everything crashes. But it's just, again, overanalyzation. The better deal syndrome is real. And I think it's important for investors to say, this is what I want, and then go out and get it. And if you have to pay a little more for it, you will not sweat it. In fact, Scott, I think you can agree with this, and we've talked about this. Like, our biggest regrets are never what we bought. Our biggest regrets are that we didn't buy more, or properties that we just didn't buy because we felt we were overpaying for it. Right? I mean, I'm right about that. Right? I mean,
I agree. And it's like we have deals that maybe we weren't overly excited about buying. I mean, we had some, I wouldn't call them mistakes, but we had some things that we thought we were going to do one plan with it, and it had turned into a different plan.
That's right.
Because we were upside down temporarily.
Mm-hmm.
But you're right. In the long run, they right-sided themselves because of appreciation, and it may take a few years, but in the long run, generally, when you factor in all those other areas of, return, it does pay off. No, can you lose money in real estate? Oh my God, yeah, you can
Mm-hmm.
make some huge mistakes if you had really bad advice, or I'm sure everyone's heard the nightmare stories about buying a money pit and things that had got awful problems. But generally, though, if you do your due diligence on a minimum level, get your home inspections done. And, there was a period where people weren't doing that, but
Right.
it's kind of maybe back, people are
Right.
doing, hopefully. But yeah, still though, today's market, you have to make decisions quickly. I mean, there's this limited inventory. And, we're trying to explore areas that maybe give a little more time, like some of our newer markets we're going into. But here in Central Indiana, at least, you have to pull the trigger. I mean, if it's a good property, you're gonna have competition, and you're gonna have to pull the trigger. So do your due diligence, but do it quickly, and then get your offer made. And yeah, we've also seen people that are just kind of like on the fence forever. Like, should I do it? Should I not do it? And, at some point you have to decide, do you want to become a real estate investor or not? And if you do, you just got to do it.
That's right. You're right. You have to, am I going to be a real estate investor or not? Because there's a lot of tire kickers, a lot of wannabes. That's why I remember so vividly the first time we said, okay, let's buy it. That's a big decision. And I will tell you though, that the second, third, fourth, fifth properties become much easier, right? Because that initial fear is over. And, you and I said, we're going to buy one property a year, and we ended up buying one property a month. It was about what we were doing, and we got the fever, and boy, I'm glad we did. I mean, I think we're both of us much better off for it.
Yeah.
So,
like I said, the biggest regret I have now is we didn't buy more.
that's right. Absolutely. Okay. Mistake number 4 that new investors make is that they don't look long-term. Talk about that a minute.
Yeah. I don't know if I blame infomercials and the Carlton Sheets real estate school and all that stuff. But, people talk about cash flow and getting checks in the mail, and, cash is king, and it's sexy, obviously.
Mm-hmm.
But, if you focus on that only, I mean, you're missing out a lot of other aspects of real estate investing that build and can help you in the long term. And again, I guess it goes back to our strategy. We've mostly approached at least our holdings from a long-term aspect. And I think that's moved the needle the most in my financial results, I guess.
Mm-hmm.
And I'm sure it has you as well, is that, initially that was, we put what we had into it, and, we were, we didn't come with silver spoons in our mouths. We had to earn that money and put that into real estate. And, it has appreciated. And now that has become a big bucket of assets that we own that's going to provide us with hopefully a nice retirement at some point. Right. But, overall, I think having the right mentality, this is not a penny stock. It's not a stock market investment. It's not going to have that rapid, daily transactional wow factor. It's more of a long-term play from a lot of aspects, from a results aspect, and from, if you look at your month-to-month cash flow, I mean, you're going to drive yourself crazy. I mean, you're going to lose your hair, you're going to turn gray or whatever, because, there are going to be rocks and bumps in the road. And so if you look at, okay, this month I didn't get my check in the mail, that's going to be really tough to swallow. But if you had the reserves and you set up, those type of things, and look at it from a business that needs to be self-sustainable first, and then maybe if it has a return on a yearly basis, you can take some income off of, that's fine. But, I can honestly say that in the 20 years we've been investing with our real estate, we've never taken money out of that business.
That's right.
We've kept it as a self-sustaining business, and it has reserves. It has, profit and loss each year. We've had years where we've lost. We've had some years where we had good cash flow and made some money, but then with tax write-offs, obviously there's some tax sheltering that we always take advantage of and really appreciate. But at the end of the day, we didn't look at it as a paycheck. I mean, we looked at it as a long-term wealth building event. And I'm not saying it's made my life easier or made my life less stressful, but I don't know. I think I would be insane if I didn't think otherwise. I think I have been really, really bonkers, like stressing about every little penny and worrying about every little transaction.
Yeah. There's a lot of good stuff there to unpack. I mean, you and I were landlords first, and then we became for lack of a better term, has some people I think it has a negative connotation, but we were flippers for a long time. And we made good livings being flippers, but we didn't, and maybe we put some of that away, but we spent a lot of that money, I'm sure. We didn't necessarily gain wealth from flipping, right? Now, I think there are people out there that did a lot more volume than us, and we've actually had one on this podcast that could say they probably built a good amount of wealth from flipping homes. But for us, flipping homes was more about, this is our paycheck, this is what we do. The rentals were, this is our long-term asset appreciation stuff, because it's like any stock. Even when you flip a home, when you sell it, it will never make you money again. It's gone, right? So you're always looking, and I remember that pressure of always having to find the next deal. So it's just a different thing. And the sad reality, I mentioned it briefly earlier, is that we have many examples of investors who just quit really early because they didn't look at it long term. Maybe the first month they owned a property, or second month, their furnace went out. And that sucks. I mean, that's a bad thing. When you're a new investor, it's like, whoa, now I've got all my cash flow is more than gone this year. And this is horrible. I was sold I was conned, whatever it is. I never should have listened to that person who told me to invest. This has been a nightmare. But I do think, and we've seen examples of this, that people that just kind of stay the course, look at it like a business, and again, have that long-term vision for the property, are the ones who ultimately see the best success.
Yeah, I totally agree. And I think it just, not only from a business aspect, but just from a personal wellness aspect, I think it just helps, sleep at night. And, obviously you need to pay attention and be aware of your investment, but, focusing too much on the short term is definitely could be frustrating. So,
all right. Well, that's the top 4 mistakes that we see new investors make. Scott, thanks so much for joining me. I appreciate it.
Yeah, it's been a good time. And again, I feel that, one of our main aspects of doing these podcasts is to help people, and hopefully, we were able to give some advice today to help people get over some issues or think about things differently. So
yeah,
good,
absolutely. We hope everyone, yeah. I mean, we hope everyone's picked up some information that'll help them with their investing. We'll be back next month with another podcast. In the meantime, we encourage you to share this podcast with your investing friends. Leave us a review, and don't hesitate to reach out to us with any questions. Until next time, thank you so much for listening, and please stay invested in your investment.